Friends, I'm sure after the excellent session which we had of Ms. Indra Anand from Tata's, we have an extremely learned faculty now, Mr. Ramesh Khaitan. Mr. Ramesh Khaitan is a very senior person. He has excellent academic qualification. He has graduated from Umesh Chandra College, and thereafter he has done his law from Calcutta University. He's also a company secretary, and he is also winner of various prestigious international tax review Asia Pacific award of 2020. He's also winner of prestigious ITR Asia Pacific Transfer Pricing Director Team Award for 21 and 22. On direct taxation, he's currently on the direct taxation committee of IMC, also on the taxation committee of FICCI, and various other forums such as CII and IFA as well. He's currently the senior vice president taxation and global head with Lupin Limited, a very leading top pharmaceutical company. And as a global head of Lupin, he has supervised various transactions and is currently leading a large team. Earlier to this, he was working with the Ispat Group and also at various other positions. His biodata, in fact, is just amazing. It goes on and on. But I would like to only say, in spite of his ill health, he has suddenly fallen ill because of the weather. I'm sure all of you are aware. His commitment towards the profession and towards the fraternity is just unbelievable. On behalf of all you present here and on behalf of the CA Institute, I would like to personally thank Mr. Ramesh Khaitan for being present online. And I once again thank him on behalf of all of you to spare his valuable time. In spite of his ill health, he's present here. And sir, thank you so much. And I request you to please now address the gathering. Thank you.
Hi, good morning, friends. First of all, I would like to apologize because suddenly I fell ill and I'm running temperature, so I got myself excused that I can talk on online platform rather than being personally present. So I will just restrict myself to the pharmaceutical industry and what is happening around the pharmaceutical industry. See, pharma is a very highly controlled industry, a very highly regulated and controlled industry across the world. There are for various kind of curves in the sense quality controls, inspections, etc. And there are the challenges. I would talk about the challenges faced by the Indian pharmaceutical industry. You see, India is the global hub of generic products, and India's total turnover around 2030 is estimated to be $230 billion. And India is going to be a major player in the world. And Indian pharmaceutical industry is not only going from generics to specialty drugs or complex generics. So India is slowly moving from generic to value-added drugs. Now I'll talk about something about the issues which are quite burning for the pharmaceutical industry. One is scientific research expenditure. Now with the onset of or on the impending of global global developments like BEPS and digital economy, that when it covers pharma company, it will have impact on the pharma company because of the rate of taxation, etc. Slowly, all the intensive incentives have been taken away, except for SCZ, and we have reduced rate of taxation under section 115 BBF. I think that is 17% tax rate. So all incentives are slowly withdrawn, and the research was one where the cutoff date was 2020, and thereafter only research qualifies for 100% deduction in respect of revenue expenditure and capital expenditure, including building, but accepting land, value of land. So there were, we are lagging, or the world across is far ahead with us in so far as the preferential rate of treatment of income arising from R&D is concerned, or the preferential treatment for R&D expense are concerned. Like various countries allowed accelerated depreciation for R&D assets, R&D expenses, or tax credit in one form or other form. And and the government of India, considering, I would say, Action 2 is more on PLI scheme. So PLI scheme has not been so successful because of the certain constraints and various rigorous conditions imposed. So now we are going to have soon some PLI scheme for research also. So in research earlier, the decisions, the issues were to what extent the deduction would be allowed, weighted deduction would be allowed if there is no Form 3CL. So law is fairly settled that till assessment year 2016-17, if there is no approval of expenditure, but the R&D centers are recognized and approved by the DSIR, then you don't need 3CL recognition for expense, and the expenses have to be allowed at an accelerated rate, that is maybe 150 to 200%. And then from assessment year 17-18, when the Rule 6 was changed with the insertion of Rules 7A in Rule 6, now the law requires that unless the 3CL is there, you will not get the weighted deduction. Now, as you all know, that DSR is taking too much of time. Like in my company's case, we have not received 3CL. Even my assessments are going for assessment year 21-22, but we have received DSIR approvals like Form 3CL up to March 19. And then there are various expenses, despite confirming to the DSR guidelines, they are disallowed by the DSIR suo moto. So what is the action against that? The law does not provide any remedy. If you technically ask, literally, I would say, the law does not provide any remedy like appeal, etc., except to go to the High Court and file the writ petition. And then there is also a decision of Karnataka High Court, which says in Boss case, the DSIR, before disapproving some expenses, give the opportunity to the taxpayer, and then it can disallow some expense. Second issue is that if DSIR approves 100 and the company incurs 150 rupees, so now of late there were conflicting decisions, but now the current view is that to the extent the expenses are approved by the DSIR will only be eligible for weighted deduction, and the rest for you have to fight. Why I'm saying there is no remedy, because if you see section 3, subsection 3 to section 35 2AB, it says to what constitutes the R&D expense. The only authority in the world is DSIR. I'm saying for the Indian context, that this portion is R&D. And beyond that, and if the department says, or the assessee says that no, if the department says that this doesn't constitute R&D expense, then the assessing officer through CBDT has to approach to the DSR. The CBDT has to approach and then say that whether this this qualifies for R&D expense or not. So in a way, the final word of DSIR, the word of DSIR is the final word. Now, supposing I am just talking that if the SSC has incurred 200 rupees and DSIR as per its guidelines only approves 150, but the 2x100 are expensed out by the SSC as per the DSIR guidelines, what happens? Now, there is a clear cut. Some people, most of the people are taking that route is the CIT appeal and the tribunal. But one reads section 35 2AB 246, etc. Then the only course of action is a writ petition before the High Court. This is one. Second is uh, uh, now clinical trials, if they are incurred outside R&D center, then what happens? So earlier DSR used to write in the form 3CL itself that so much of R&D clinical expenses are incurred outside. And the Gujarat High Court took a view that for clinical research, sorry, not Gujarat High Court, then various tribunals have taken a view that these expenses are to be allowed, even they are incurred, but provided there should be clinical and analytical charges, because in India, these facilities are not available made available by the government to the SSC, and the taxpayer has no option but to go to some clinical organizations or centers to carry out the clinical and analytical studies like BAB, BA studies. So there is one Bombay tribunal decision, OCARD, and Concept Pharmaceutical, that had taken adverse view against SSC, but that has been subsequently not followed, distinguished by OCARD, Pune tribunal in OCARD, and then there are various Bombay tribunal decisions. But I'm fighting one matter before tribunal, where the department has relied on one Hyderabad tribunal decision. They said to the extent it is government introduced section 115 BBF. Now, hello.
Yes.
So now if you read section 115 BBF, 100 BBF says with effect from assessment year 2017-18 and subsequent years, income received by a resident SSC by way of royalty in respect of patent developed and registered in India shall be taxed separately at a flat rate of 10% without any deduction in respect of any expenditure or allowance under any of the provisions of the Income Tax Act. Now we have to see patent registered. It talks about developed and registered. So patents, supposing the patents are developed, but they are not registered, then one cannot take the center of money, cannot avail the concessional rate of tax of 10% under section BBF. Now, the patent has to be registered in India. And if you read section 1 of the Patent Act, it applies only to India. Now, who will buy the patent or take the licensing of the patent outside India? Because Indian patents are not enforceable outside India. They are only enforceable in India. So this is one area where various representations have been made to the government. Unfortunately, the government neither the government nor the CBDT or revenue secretary nor the revenue secretary have been able to understand the nuances. What is the patent registered? It says patent registered. Now, like in US, there is FIDI income. Now, what FIDI income says? FIDI income says exploitation, any income, whether it is commercial or sale, or commercialization of product out of that technology, then you get 13% tax, concessional tax rate. That income will be taxed at 13% concessional rate of tax. So it includes not only royalty, it includes sale also, and it includes commercialization, which is in our case, the act allows only patent registered in India, and the income should be royalty in nature. Now, royalty, there have been royalty in this case has to be distinguished from the meaning of royalty as contained in the Income Tax Act 916. Read with explanation 2 there too. And the definition of royalty in Article 13. So here, if it says, the royalty says all rights, transfer of all rights. So under treaty, or if the transfer is of all rights, then it is not royalty, but under the domestic tax laws, it is a royalty. So if you transfer, sale, license or sell the patent, the pharmaceutical company would be taxed at 10%. It's not pharmaceutical, it all the technology companies, they would be taxed at 10%. The problem is that the patent, who will buy the patent which is registered in India, unless you have global patent rights, like pharmaceutical companies derive sales, most of the sales from, say, especially from North America. And there are some markets like Europe, where the Indian companies make sales, or they do the technology licensing, etc. Now, those income are not covered by 115 BBF as it is presently stated. Now, this is, and then this patent box. Now, again, in this context, I would like to talk about the BEP section, like DEMPI functions and Circular 5 issued by the CBDT. The DEMPI functions says it's nothing but it is who is the entrepreneur, who is the captive service provider, and who is the legal owner. So we have to, like say in country A, that is America, there is one company which does the research. There is another company, says in Switzerland, there is a company called B, which owns the IP, and it has some substance like research people, but they cannot do the research side. I would rather say inhalation kind of research, which is India is not capable. And then the US outsources some research functions to India. Now, this has been a very burning issue now. Who is the owner, entrepreneur, who is controlling the risk, who is, etc. Then, and this has been now, whether it is India or UK, US or Switzerland, according to me, the answer would be in favor of US, because US is the person, is the country where from all the decisions, entrepreneurial decisions are taken, because it is capable of not only designing and developing the research, but carry out the research also. Merely because a certain part of the research is outsourced to India, it doesn't mean that India is performing the DEMPI function. So it becomes the owner, entrepreneur of the research. Second issue is whether capital is the engine and knowledge is the bogie, money is the train. So here, BEP section 10 talks about that is, there are examples, various examples. They have made various differentiation between a third party, like in US. In India, you will not find any PE capital fund, PE fund, making investments in technology, etc. It is based, most probably it is Germany or US and Germany, where you find the investment firms like PE funds. So if they fund the R&D, they keep around 30-40% margins of the profits, royalty, etc. From the money. If they invest 10x, they get 40x. 4 times they can make, or 30x. It's again the commercial arrangement. But if it is between the related party, then they say in the related party, in the case of related party who is making the funding, despite being carrying all the financial risk, it will. And then there is technology, it is driven by technology. But without capital, the platform will not survive, because you need deep pockets that keep funding the losses. And then when the technology becomes successful or it is commercialized at a much larger scale, they start recouping the investment. So this is another area where I think OECD should think about. So though technology is very important, critical, because without that there could not be any revenue potential, but still capital enjoys the equal importance. Without capital, you cannot develop the technology. So this is one. And then Indian companies do a lot of like licensing agreements, or they sell IPRs. So the question of or settlements receive considerations in para 4 filing settlements, or some patent settlements. So the income is whether revenue or business income or capital gains. So one need to analyze where the patents are settled. You are going out of the business, whether you qualify the or meet the condition of 28(5)(a), then it could be capital gains. Otherwise, it would be business income. Second is, how do you classify this income in your books of account, whether it is income from operations, regular income, or it is non-regular income. And we should be equally mindful of representing in the annual report. So what kind of disclosure we are making? This is one settlement. And the second is that when the IPs during the development stage or work in progress stage, they are transferred either to the related party to unrelated party. Whether this income would be chargeable to tax as business income or capital gains. My inclination would be that subject to it could be long-term or short-term. One first. Second thing, whether such is a regular business. My research is my regular business, and selling technology is my regular business or not. One need to decide that. And after considering all the facts, we can safely say that it is income from capital gains. And because it is a property, one need to go into section 22 within bracket 4, read with 211. It talks about the property of any kind, which Supreme Court in Ahmad GF Arif's case has said property is of very wider term. It includes not only the property, but all the rights associated with that. So one is that if it is transferred, when the IPRs are transferred, one need to assess whether it is a capital asset, whether it assignable or transferable, and and if it is transferable, then there could be capital gains. and there is decisions on this issue are various of AAR and two decisions. One is Foster India and then Pfizer Corporation. And then there are various court decisions. If it qualifies for property or rights of any kind, then it is assessable as capital gains. The second burning issue is doctor's pain. Now, Supreme Court recently has said that any expenditure incurred on doctors is covered by explanation 1 of section 37, explanation 1 to section 37, and it has settled the controversy. I would not go into the nitty-gritty of the Supreme Court, but Supreme Court went into the extent of more on ethics and US Sunshine Code, etc., related to the pharma, and it decided against. Now all the courts, including tribunals, they are taking a view that any expenditure which is covered by DSR, MCI guidelines or regulation is to be disallowed must suffer disallowance in the hands of the pharmaceutical company or associated company like healthcare industry, or even it could be your diagnostic centers, etc. Second is the samples. Now samples again, there are conflicting decisions that samples given to the farmers to conduct the efficacy of the product is allowable expenditure. It is not an advertisement or promotional expense. Now, this is now from this year, March 22, after March 1st April 22, now one has to carefully read explanation 2. That says any law, guidelines, etc. So for samples, we need to see USMP sorry, not USMP. This is UCPMP guidelines. Circular 5 issued thereunder. So it talks about that the samples should be given to the doctors only if there is a written request by the doctor. The doctor must submit the records of how the samples are used. It should also contain the list of the patients to whom the samples have been given. So, so one need to go into Liva Healthcare's case, where it has at length analyzed why doctor samples should not be disallowed and this Liva Healthcare has been talked extensively in the memorandum explaining the amendment to section 37 in the Finance Act 2022. So according to me, now my personal view is that doctor samples would suffer disallowance unless it meets UCMP guidelines. Second, another issue is brand reminders. So in brand reminders, we can classify brand reminders in 2 parts. One is in clinical and non-clinical. Non-clinical would clearly suffer disallowance. Clinical, anything 1,000 clinical brand reminders, anything above 1,000 invites censor for the doctors. Hello? Yeah?
Yes.
So anything which is given as brand reminders here, I can say pencil, etc. The value should be general public items, and the value is less than 1,000 rupees for each article, then it will not suffer disallowance. But these brand reminders and samples have to be read with section 194R. Section 194R says that anything given to a person in excess of 20,000 rupees in a year in aggregate will require TDS at 10%. So how do you keep the track of brand reminders or samples given to the doctors? Because 194.1 read with 194.3. One has to read 194.3 and 194R. 194R now, one talks about the prosecution on pharma companies. If the pharma companies do not comply with the provisions of section 194R. Now under 194R3 says that the circular issued by the CBDT would be binding. It is in contrast that earlier the stand had been that the CBDT circulars are binding only on the tax officers and they are not binding on the taxpayers to the extent they are adverse to the SSC. So now the binding force is given the parliamentary approval, not only parliamentary and both Rajya Sabha and parliamentary approval to the CBDT circulars. CBDT has issued 2 circulars on this. So for pharma industry, now one has to read very critically. The pharma industry should critically understand what circulars talks about brand reminders, doctors meet, your distributors meets, etc., and samples. So now there is a petition, writ petition pending against 190 constitutional validity of section 194 before the Karnataka High Court. So far that petition has not been, it was heard, but it has not been disposed of. I presume that this petition is under section 190 within bracket subsection 2, because TDS provisions yield to subsection 190 within bracket 194 should yield to 190 within bracket 2. Nothing in this section shall prejudice the charge of tax on such income under the provisions of section 4 within bracket 1. So unless this writ petition is disposed of and the decision comes in favor of the SSC, I don't think the SSC would enjoy any liberty. The taxpayer have to be very careful, especially the pharmaceutical companies have to be very careful in implementing the 194, the provisions of section 194 read with the circulars. And any default will not only invite the penal provisions like prosecution, but pecuniary provisions also like penalty, interest, etc. Now, another area is advisory consultancy fee on which the pharmaceutical companies deduct TDS 10%. But it happens in some of the cases, doctors do not give their PAN numbers. Then you go to 20%. From 10%, you go to 20%. And that 20% has to be grossed up. Now, again, one has to refer if I don't give the PAN number, there would be penalty. Levy, there could be levy of penalty under section 272, I think K, some 272K, I don't remember exactly the section. So whether it is this penalty of 10,000 is for each default or for all the default in a year, that is again, there are 2 sets of school. One school talks about that it has to be, the penalty has to be recurring, like if you have made 100 payments to different people, then for each default, you have to pay 10,000 rupees as penalty. Whereas in my opinion, as an advocate, which is now I'm practicing as an advocate. So my view is that it has to be read in consonance with 139A and the other provisions of 270K, and the penalty has to be single, only 10,000. Again, there would be a lot of debate on this. This is again a fertile area. Brand reminders, I forgot to tell you, below 1,000 rupees, because there are no censor to the doctors. It has been allowed as a deduction for in-clinical items. In Himalaya drug, 188 ITD 201. And then again, there is one case, Himalaya Wellness, that is Tax Sutra. It is reported in Tax Sutra 361, Bangalore decision. It's a TP case. Now again, so even after this brand reminders, doctors spend whatever advisory fee. Now people are claiming, most of the pharmaceutical companies are claiming, are entering into agreements for advisory or consultancy fee with the doctors. And and pharmaceutical industry per se is taking a view that such payments are not covered by MCI regulations, clause 6 with clause 6.8.1 within bracket small g, which talks doctors or medical practitioners can act in the capacity of advisory, consultant as researchers, or in any other professional capacities, provided they must ensure their professional integrity and freedom, ensure that the patient's interests are not compromised, ensure that such affiliations are within the law, ensure that affiliations / employments are fully transparent and disclosed. So unless these 4 conditions are met, and the pharmaceutical companies see that the doctor is complying with these 4 conditions, this consultancy fee, etc., or advisory fee, whatever name you call, will not be allowed as a deduction. And there are 2-3 decisions, tribunal decisions, which have come recently. We say that it is nothing but a camouflage. In the garb of camouflage, the pharmaceutical companies are giving payments to the doctors. And so they are also covered by the Supreme Court decision, and the disallowance has been confirmed. There are 2-3 decisions actually. And then the second thing is that the pharmaceutical, there are 3 decisions. One is Galterman Pharma India Limited. It is reported in Tax Sutra. And then Boston Scientific, and one is Agio Pharmaceutical, again Mumbai Tribunal. So these are the 3 decisions where consultancy or advisory payments to the doctors have been confirmed as disallowance. Now we come second most pertinent issues, like pharmaceutical companies, various big multinational Indian pharmaceutical company, they make sales in US. And thereafter, in one form or another form, they reach to settlement agreement, like antitrust law, like then pricing agreement, that is that you are acting in concert and not reducing the price, jacking the price, so which is not in the interest of the public at large. So there are various, like patent infringement, etc. These kind of settlements, 4 or 5 kind of settlements are generally settled by the Indian pharmaceutical companies. So till 2022, 31st March 22, mostly the answer was that any law, that the law for the time being was interpreted as the law in India and not otherwise. Now, so there was Mylan's decision, Hyderabad Tribunal on one, Delhi High Court decision, which said Descarent Rotors 347 ITR 32. It says that law means Indian law and not the foreign law. But again, Delhi High Court distinguishing the favorable decision of Delhi High Court in Rotors, Desiccant Rotors International 347 ITR 32 in Northern India, Chemical Industries, Chemical Distributors Limited 248 ITR 790 Delhi said that law means the law for the time being would also mean the foreign law. So one has to be very careful that whether explanation one will cover Indian law or the foreign law. So one has to, the pharmaceutical industry must go whether this settlement is for any infringement of law. If the settlement is made, had the settlement been not made, whether there could be penalty which was compensatory in nature, or there could have been any penalty for infringement of law or breach of law. So one should, I would advise that the pharmaceutical company should take the senior counsel's opinion or lawyer's opinion in US or any other country like Australia, etc. That by settling this amount, there is no breach or infringement of law of that country. So if that opinion is taken, then we are fairly sure that that this settlement is compensatory in nature and not penal. Not again, the third issue is this. Again, another issue is explanation 3 to section 37 within bracket 1 is retrospective or prospective. Now, as we see the memorandum and the language, the intention, the legislative intention behind the introduction of explanation 3 is that it is prospective in nature. It is applicable from 1st April 2022 onwards. But recently, two decisions, one in the context of section 14A, and another in the context of explanation 1 to section 30, explanation to section 37. The Calcutta High Court has said that explanation 3 is retrospective in nature because it is clarificatory. But again, in another case, Infosys case, again, it is reported in TII. They said in para 138 to 142 of the order, they said that explanation 3 is prospective in nature. Now, again, there are dichotomy of decisions. There is dichotomy in decisions. They are at variance. Calcutta High Court says something and Bangalore Tribunal says something. It is prospective, whereas Calcutta High Court says it is retrospective. Now, there are Supreme Court decisions like various decisions like Vatika Township, Bharat Patel, Snowtex, Vijay Technologies, Aqua. So they talk about that when the intention of the legislature is to make the provision prospective, then they are prospective in nature. But again, in some other cases, Supreme Court says that if there are conflicting decisions and there is no High Court decision, then it should be treated as clarificatory in nature and retrospective in nature. So that is, one is Podar Cement's case in Supreme Court decision. So again, this will be again Pandora's box for litigants. People will say that explanation 3 tax authorities are taking a view, whether rightly or wrongly, they are saying including section 14A also. They are saying it is clarificatory, both sections, explanation 3 to section 37 and 14A are clarificatory, and therefore they are retrospective in operation. So these are some of the decisions on direct tax front, that is corporate tax front. These are the areas. And the other areas now I would cover is corporate, customs data. For benchmarking whether custom data from tips can be used as comparable data or not, the answer is yes. And the answer could be no also, because there are conflicting, but of late in the recent one, 150 taxman.com, I don't remember the citation. The Mumbai tribunal says that customs data should be used as comparable data. And there are various decisions now, not only this, the latest one, there are earlier decisions which say the custom data can be clarified, can be taken as comparables. Second is the corporate guarantee. Like in corporate guarantee, again, this is relevant for other industry as well, pharma companies, because pharma companies do lot of corporate guarantees to their subsidiaries in foreign jurisdiction, especially the companies are set up in US, so their working capital requirement, etc., loads. Indian multinational pharmaceutical companies provide guarantees. Now the law is settled that corporate guarantee is an international transaction, and the taxpayer should be compensated for corporate guarantee. And what should be the guarantee fee? It should be computed by benchmarking the corporate fee transaction. So now people are more and more companies are benchmarking guarantee fees, and therein they are using the interest saving approach, that 50-50%. There was Rangachari committee's input in this, that 50-50 can be split between the parent and the subsidiary. But now the department is saying, no, we will not go for notional approach. We will go for actual approach, and the split should be 70-30%. 70% in favor of the parent and 30% in favor of the subsidiary. So, and so therefore, a lot of adjustments were happening. Now, two tribunal decisions have come that yes, you can use the interest save approach using the notional saving, and these decisions are I would say yes, anti-infective. One is 2040-50 taxman, another is Dabur India, and then recent one is again Dabur India. There are two decisions in 2022 and 21. There are 4 decisions on this. And most of the companies in the past, they have not done even if you have done the transfer pricing study, I just forget about that to keep myself short. Even if the transfer pricing study is done, the department rejects the transfer pricing study without doing separate benchmarking, and they impute guarantee fee at a higher rate. So in that case, there could be 2 potentials for reducing the litigation. One is if the transactions are quite heavy, money involve huge tax implications, then the APA is the best and safe route. Otherwise, one can rely on Reliance Bombay High Court decision, which has kept 0.5% as the guarantee fee. You cannot make more adjustment more than that. And that has been SLP has been dismissed by the Supreme Court against that decision. And then there are decisions that any guarantee fee between, Everest Kanto, not, I was wrong. Everest Kanto's decision, that is Bombay High Court 378 ITR 57. But one can also, again, the department is making more adjustment on account of guarantee fee than when there are various tribunal decisions where 25% to 35.35% is accepted as guarantee fee, provided the benchmarking is done. And one can refer to safe harbor rule also, rule 10 T capital A. For another litigation is letter of comfort. Now, letter of comfort, there could be again performance guarantee. Are they corporate? They are guarantee, or any fee should be charged when there is no implications, financial implications or outgo for the parent company. Department is making adjustments, imputation of guarantee fee for both letter of comfort and performance guarantees. And there are various decisions on letter of comfort. There cannot be any imputation of guarantee fee. So again, it is fact-based, but the judicial symmetry is that various high court have said that letter of comfort is different than corporate guarantee, and one can refer safe harbor rules, rule 10 TA, though there is specifically no decision on this rule 10 TTA, so 10 TA, but one can argue that rule 10 TA also excludes letter of comfort for charging guarantee fee. And then I'm skipping various things like interest receivables, interest on delayed receivables. Again, they are international transaction of late they have. So whether any imputations, there should be any interest imputation beyond the credit period, the answer could be yes, and the answer could be no. If it factors into working capital adjustment, then anything which, if the receivables are beyond the credit period allowed, and wherein the working capital adjustment has been factored in, then there could be adjustment. So I'm not going into integrity, this litigation integrity, but again, these are various fact-based. There are hundreds of decisions whether there could be interest receivable, delay receivables are separate transactions, international transaction, or part of the sale itself, whether they are international transactions, whether there should be any imputation of interest. If the company is a debt-free company, whether there could be interest imputation. If the later credit period is say 180 days and the receivables are beyond 210, or say the realization is 210 days, then whether the entire credit period money, you should ignore the 180 days, or the interest should be charged to the entire period. Recently, Mumbai Tribunal has said no, it has to be only for 30 days. So there are various things now, which will then the working capital adjustment, etc. Now I go into now GST. Have I some time?
Yes, sir. Yes.
So I'm keeping myself very short, trying to keep, because these issues are close to my heart, like PE, etc., secondment. I'm not talking about those things because I can speak 4 days on this topic. So now there is, the first issue in indirect tax is a GST refund, that is surrender recredit of ITC. Rule 96B inserted with effect from inserted in 2017 with effect from 23rd March 20 mandates that an exporter of goods to repay the GST refunded to him proportionate to the export proceeds not realized. Now, there are two things. Most of the time, most of the exporters, what they do, they pay the they pay the GST on export and claim the refund. So the GST is paid from input tax credit, but that is nothing but a working capital sitting with the company, and then they claim the refund. Now, supposing if some part of the export is not realized, then to that extent, the export that GST refund has been claimed has to be returned. Now, or in case there is a full write-off, then it has to be refunded back to the department. Now, supposing the exporter, pharma company which exports pharmaceutical products, rather than claiming refund on an exports, uses input tax credit. In this case, it doesn't use the input tax credit. In that case, it is not required to refund or adjust the input tax credit. So this dichotomy, we have made a presentation that this should be clarified, that the pharmaceutical, the persons who are claiming refund by utilizing the input tax credit should not be at a disadvantage stage than the people who are not utilizing the input tax credit by way of refund. So that should be treated as part. Second is the GST refund. There is a huge challenge in GST refund for SEZ units. The GST laws allows exporters both in DTA and SEZ to pay GST on exports and claim refund for the same. However, SEZ online module presently does not provide a facility for exporters from SEZ unit to be affected on payment of GST. At the time of preparing the shipping bill, an auto-generated declaration supply meant for export by SEZ entity under bond or letter of undertaking without payment of integrated tax gets printed in the shipping bill. So I'm saying the online module is not made in is not changed or customized to permit export on payment of GST. So that is creating a lot of difficulties for the exporters of pharmaceutical products for claiming GST when the GST, so that from SEZ export has happened on SEZ. So we are requesting that this should be customized and both DTA and SEZ should be kept at par. Third is out of court settlement. Now, what happens in recently, some of the pharmaceutical companies, big pharmaceutical companies, I would not name them, they have come out, they have reached out to me that we have reached to settlement in US and the amount involved is say $200 to $400 million. And the GST department is asking us to pay GST on this settled amount under the reverse charge mechanism. There is no clarity because GST laws only talks about that there would be no levy of GST on liquidated damages. So by one way or the other way, the pharmaceutical companies, they come to the pressure and pay the GST under the reverse charge mechanism. And now, again, the issue is that whether it should be this input tax credit under the reverse charge mechanism should go to the unit from which the export had happened earlier, and because of that, the settlement happened, or it should be at corporate level. So there are a lot of brainstorming or hair splitting, and so there is no clarity whether it should be apportioned between the units or it should be at head office level. So this is a very heart-burning issue for pharmaceutical companies, and in the process, a lot of money is getting stuck. Now again, if there could be again now the same way there could be any, if there is any settlement in India, there could be GST under forward charge mechanism. So again, there is no clarity on this. So where the credit should go, how it should be apportioned. So there is no formula, there is no nothing. So different people are taking different view. And then the fourth issue, which is most pertinent, is the GST on employee salaries. Now under GST law, if the head office personnel, they are working for any, say, working for any other establishment of the company, say like we have our head office in Mumbai, and I'm looking after GST matters of, say, Patna office, or say 20, our establishment across 29 states. And under the GST, these branches are treated as distinct persons under section 25 of the CGST Act. And there is one AAR ruling also, that there is one AAR ruling that yes, it has to be, there should be GST cross charge on such services. But again, I think that there is a concept of legal person and legal entity, sorry, not legal person, legal entity. And the legal entity is the company itself. So there should not be any cross charge mechanism for head office HO employees. And again, the various representations have been made to dispel this ambiguity and potential litigation on this issue. We hope some clarity should come, but still. And then another issue is centralized jurisdiction for audits and litigations. So again, there are 29 states, 29 audits, 29 orders, 29 litigations. So this is becoming very cumbersome and time consuming and not cost effective also. So we have requested the Finance Ministry that it should be combined together, all the cases like large taxpayers unit, you should have LTU, which was disbanded. It was a very good scheme, I would say, large taxpayer unit, under which the accumulation of the GST or service tax was accumulated at one place, and then it was as and when the payment was to be utilized among the various pools pockets. So we are asking again, we are requesting that this should be centrally managed. There should be some kind of LTU kind of thing, where everything should be under one roof only. And the other issue is interest on delayed receivables, delayed sanction of GST refund. Now, if the SAC, suppose there is a litigation, and the assessee files application for GST refund, but there is litigation and the order, then the audit order comes granting the appeal is in favor of the taxpayer. So whether the taxpayer should be given credit uh, uh, interest from the date of application, the GST department is officials are taking a view that there is no such delay attributable to the GST. After 60 days of appeal for interest eligibility, you have to see the 60-day pooling period. If the refunds are made within after the appeal order within 60 days, then there cannot be any interest payment on GST refund. So these are the some issues. Any other questions I would like, any questions from the audience I would like to answer.
Thank you so much, Ramesh ji. Yes, now the floor is open to the audience. Yes, friends, any issues, any questions?
Though I have shared my write-up, though I have shared my write-up on GST and this some 14 pages, I have prepared one note. If WIRC, if they want, they can circulate amongst the audience also.
Sure, sir. We will do that. We will do that, sir.
Yes, please.
Yes, friends. Anything you want to know or discuss about the pharma? Anybody is representing here from the pharma sector? Nobody is from the pharma. So what is the outlook of generally the pharma companies? Because I was just trying to understand because of this fierce competition and all. Is it going through a turmoil right now, or it is a good phase?
See, pharma industry is going was under turmoil stage since 2018 till 2023. So and in generic products, the refund margins which were around used to be around 80-90%, they have come down to around 20%. So there is quite a bit of price erosion. And second thing, there is a consolidation of the customers. They have only formed kind of cartel. So there used to be earlier 10 channel partners. Now they are 3 channel partners like Amazon, Walmart, and one more. I don't remember exactly the name now. So now they are asking the price that we will buy at this price, whether you want to sell or not. And the third is the US FDA inspections. Now all the pharma companies are under US FDA audit, and earlier they used to inform and then come. Now they have set up their office in India itself, and they come without information and do the US FDA audit. And each and every pharma company, wherever they have done the audit, they give 3-4 objections. So we call it 483 warning. So it doesn't affect the manufacturing and the export as such for the existing products. But the new approvals do not come unless these 483 warnings are addressed. So it takes a lot of time. So this could be potentially because of one, yes, there could be some kind of leeway, laxity or some type of laxity or some comfort, I would say, that by the pharma companies, that they are not so proactive for US FDA audit. They have now understood. Second thing is more because of the US companies. They are putting pressure on their governments that you do US FDA audits, lot more US audits, and put kind of pressure on Indian pharmaceutical companies. They are doing the lobbies, which is not in openly, but in the open money, this is not open this thing, but they are doing lobbies. So one is that pharma, one is the pharma, pharma, there are two sectors. One is API. API are generally manufactured in China, is the number one country in the world. And second is India. They are doing the API. From API, the formulations are done. So for API industries, the US FDAs are not so stringent, but for formulations, that is medicines, they are very, very stringent, and sometimes they behave a bit sketchy also. So, and second thing, now the pharmaceutical companies have to realize that, yes, there is a lot of competition in generic products. There are around 10 to 20, 15 companies from India itself, they are in generics. So there is lot of price cut and competition. So most of the pharma companies are now focusing more on specialty, that is specialty products, that is generic specialty, and complex generics. So, and third is the other thing is that unless you develop this generic specialty products or complex products, then you will not get the first to file kind of market. That is, in that case, you get 180 days exclusivity, and you make most of the margins in first 6 months only. Other is NDDS Noble Discovery, that is Sky Blue Technologies. The pharmaceutical companies are not so finance deep pockets that they can carry out the research and spend million of dollars, and it takes 10, 12 years waiting period, cooling period, and at the end of the day, the research may fail also. So a lot of people are going for funding. So in funding, there is a lot of profit split between the funder. They take the maximum amount, and yes, they de-risk the pharmaceutical company. They do the de-risking. But again, there is no clear money, any encouragement from the government. Like we have significant economic presence, business connection, whether this funding would be treated as income from business. And if so, lot of them do not submit their tax residency certificate. In that case, if it is gross up, comes up to 67%. So these kind of stuff are very, and whether it is interest, it is royalty. So where is the source of income? So, and then we have very good AARs. No, we have good, but not so effective AAR system. Now bar has come. So far, no application has been heard by bar. And again in bar, all the 3 members are from revenue. So I don't know what will happen. So unless we have some good regulations and relaxation or something, government gives boost this funding, etc., to the funders, then pharmaceutical company will have challenges. So one is that if government has to aggressively engage with US, North America, because all Indian companies, North America is the largest market in the world, and US still is the largest market in the world for pharmaceutical. As of 2023, it is $1.57 trillion, of which US alone is around $400 billion. We come into number 14, but we come quantity wise, India is number 3 because we made lot of production, so which is cost effective. So in volume terms, we are at 14th number, but in product manufacturing space, we are at number 3. So there is a lot of scope for Indian pharma companies. But again, as I said, our education system has to improve. We have to have very good universities which imports research. So there should be synthesis between clinical chemistry research, clinical research, biopharm research. So now we have been representing to the government that you continue this super deduction for pharma industry. Government said no. So people are now talking about PLI, etc. Like China, you see, China is giving you tax cut rate of any incentive money, technology company, 17% tax rate apart from uh, 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 weighted deduction of 200% on research. And then they have tax credit kind of system also. US is also giving 13% tax rate for research income. This research income is not only purely licensing, it is commercialized. And then they give around 8% of tax credit, 8% of the amount of tax as a tax credit. Then we have Netherlands, Ireland give you 12.5%. Again, these things will go on implementation of Action 2. But I personally feel that Action 2 will not come before 2025 because US, the elections in US are sometime in 24 or 25. So unless US gives go ahead, and then neither Action 1 will happen nor Action 2 will happen. Though a lot of countries have come out their already policies, laws on Action 2, basically the first and foremost are European countries first. Netherlands came, then the France came, recently UK has come, Switzerland has come. So there, and then they have UTPR also they have adopted. Similarly, the first one was the US, that I will tax this income if somebody does not tax. So those kind of rules are coming. So India has to be also very proactive and safeguard its interest. So let's see what will happen.
Excellent, sir. Thank you so much. Sir, also I wanted to know your views because it seems that one of the other major risks in the pharmaceutical companies is also there is a reduction in demand for prescription medicine. Why this is happening? So what is the trend?
See, during actually in COVID, there was sudden increase in prescription. So that after temperament of COVID, the prescription has come down, substantially come down. Second thing, government is also encouraging that you don't write asking doctors that you write not only the brand name, but generic name. India is the country where all pharma companies are generic. You know, all products, medicines in companies in India are generic. But here the brand name sells. So it again depends on the doctor's preference, you know. Second thing, there are no quality checks. There are around 1 lakh companies in India. And they are, they have sprout like mushrooms. There are no quality checks, etc. So there are a lot of stuff which are, so over the counter sale, there are no prescription required for any medicines. So still the law has to come that like in advanced countries, no medicine can be given without prescription. But here, except Schedule H drugs, any Tom, Dick, Harry can go to the pharmacist and ask for any product without doctor's prescription. So that is another reason that the doctor's prescriptions do not generate uh, uh, bulk of the sales.
Sir, also one of the other things or one of the other major risks which the pharmaceutical companies are facing are supply chain issues and logistics issues also, sir. Do you have any views on that, sir?
Now, most of the big pharmaceutical companies, they have addressed to this risk. I think COVID have made them learn in a very good way. I think the Indian pharma and the India government, particularly in the world, they set an example, in supply chain. So there was no disruption in COVID, you see. So all the medicines were made available except the imported ones. So the demand was less for import, though the demand was very high for some of the imported medicines, they could not meet the supply chain. But in India, there was not any disruptions. So even people are like across the country or across the globe, people are taking India as a case study for COVID management. So most of the supply chains are very well integrated and all. I would say for big companies, small companies, I will not say much.
Also, sir, do you think there is any risk as far as pharmaceutical companies are concerned, as far as data breach is concerned and cybersecurity threat is concerned?
See, now we have no law on data security like in foreign money. Europe is very, very strict on data security. Our parliament has been talking about data security. They were to bring the act, I think 2 years back. Still, it has been, there is no discussion when it will come. And then, yes, one is data breach. That risk is always there, whether it could be US company, US conglomerate or Indian conglomerate. That risk is there. So most of the people are keeping their data on very high, big companies. They are keeping their data, etc., on the cloud system, and they are investing a lot on security. So there is no breach or something, but something can happen always. And people are involved. Pharma company, we are regularly taught through sessions how we should open our mails, how do we see that, what is there any virus risk, any this risk. So people are made well educated before opening any mail or going to site. And most of the sites like companies are blocking now. You cannot go to any personal site or any marketing sites. So there are some sites which are only you can use on using company's portal. The rest of the sites companies are now completely blocking. So say I would give one example that I have subscription for Tax Sutra, ITR, Taxman, and then TIITIITIOL. So so I have to take special permission for downloading. So even I cannot download some of the patches which are come. So I have to use some different platform using the IT person that you please allow me to download the patches, recent updations, etc. So pharma companies, I would say pharma or any technology company, they are investing huge in your data security, data breach, and then cyber security. So these are the things, because if you are not if you do not gear up, then you will be simply finished. Like we are using a system up to, we are giving what you call tablets to our MRs, and through tablet that they had gone to this doctor, and this we are linking those tablets with the doctor's prescription, etc. This doctor has, this is the generation where my MR has gone, how much sales he has generated, etc. He's not spending in time in sitting idle at some place. So those are the things we are heavily investing in technology.
Thank you so much, sir. Sir, do you think also there is a risk of skill sets? Do you think adequate skill and adequate availability of manpower, and also research, in terms of, because pharmaceutical companies have to also continuously innovate, and research and development plays such an important aspect. So do you think availability of skill set is also an issue for your sector?
Availability of skill, especially in research, yes, it's a big challenge, like in US, there is no synthesis between, like one, these are technological, some technological words which I am not able to recollect now. There should be synthesis between chemistry and there are 3 areas. So our college, education system is that we master the people in 3 different areas, but we do not know how to combine those 3 skills in one skills. So the skill is lacking in pharma. Pharma is very, very highly skilled, and it requires a lot of technical knowledge. So in research, we are still lagging far behind. And now the next course of treatment would be biotechnology. We call it biosimilars in India, because again, in biotechnology, we are going in generics only. So there are a lot of disease which has no, pharma has no answer, but yes, biotechnology will certainly give answer to those, some kind of disease like cancer. So there are a lot of arthritis, some related to some critical problems related to eyes, etc. So a lot of things are happening in biotechnology. So I think future biotechnology would be the major player. Biotechnology and NDDS, what we call novel drug discovery system. So US is the front runner again there. And China is another, so they are far ahead than us in technical skill research. But US and Korea, like Japan, they are in different, or Germany, biotechnology, they are in different world.
Excellent. Thank you so much, sir. Really, your insights and your views are really much appreciated. Friends, any other questions, any other views, even if they are general in nature, because whatever I have even asked.
You can talk to me anything on permanent establishment, secondment, etc. Like any international or transfer pricing issue, I would be able to give you the answers related to your industry.
Sir, I think there are no further questions. Once again, on behalf of, thank you so much, sir. Sir, once again, on behalf of all the members who are present here, and on behalf of the Institute of Chartered Accountants, thank you so much for sparing your valuable time in spite of your ill health. Sir has done an amazing job, and I request all of you to kindly carry out with a round of applause.